introduction, let's get on with this. Celebrities and influencers, they can own major businesses. And I'm going to show you today how that happens, by the way. And if they know the right ways to approach it, they can do it paying little or no taxes, which is a very appealing thing to them if they knew how to do that. If you have the know-how, you can make them your partners because you can bring to them a body of knowledge that's going to make them super wealthy and you super wealthy in the process. And the thing that I'd like to say to you today is you're going to learn what I call a major key. And that major key is how to think. Because if you'll expand your mind and open up your creative capabilities and you have a strategy or a method on how you're going to think things through, you're going to be amazed at the possibilities that are going to open up to you. So it's going to be a very exciting day. What you're going to end up doing with these celebrities and major influencers is you're going to help them to leverage their celebrityhood financially. And trust me, as you'll see, they don't know how to do it on their own. And the most expensive help that they can hire right now don't know how to do it either. You're going to see it all unfold before you over the next hour. We may run a little over today because we have so much to cram into this session that I want you to be a little flexible with me because you're going to want to stay in here till the end because we're going to be sharing incredible secrets with you right through to the end. We're always open for questions and comments. We'll have a question and answer session today. The length of it will depend on how long it takes to do the presentation. Please type your questions and comments into the question box on the right side panel. That way, if I don't get to them, I'll have them on my computer and I'll be able to get back to you with them. I'd like it if you could raise your hand if you want to ask your question or comment live. I love the interactivity. And any unanswered questions, you can certainly email me at question@bizarrefinancing.com. All right. This is a person you may know because you've seen a story about him in our basic course in Bizarre Financing Pro. And we talked about how Bing Crosby took control of Minute Maid orange juice. And we're going to revisit this story because it has a whole new meaning for us in 2000 that it didn't have when we first incorporated it into the program in 92 or 83. You're going to learn a whole new aspect of this story that we have in Pro and how to use it in today's times. The strategy that I'm going to share with you today is best illustrated by the story of Bing Crosby and the Minute Maid company, now part of Coca-Cola. And of course, everybody recognizes the product line of Minute Maid orange juice today, but this is the one that Bing started out with. It was a can of frozen concentrate. It was developed originally for the military to bring them vitamin C during World War II. And the frozen concentrate was what they used to do it. It was developed for them. And then eventually Minute Maid brought that product to a commercial use for ordinary citizens. And that happened right after the end of the war when they actually figured out they had these resources that were making all that frozen orange juice for the soldiers. Now what do they do with it? So they figured, let's commercialize it and sell it to the public. And that's how Minute Maid actually got started. So much for that part of the story. Going back to when this all happened, Minute Maid was looking for a spokesperson. And they approached the famous crooner with an offer. And the problem that Bing Crosby had is his tax bracket was in excess of 95% between state and federal. He was doing very well. So it meant that if he earned any more money, only 5% of it he could keep. The rest was going to go off to taxes. And he was a patriot and wanted to help the government pay for the war. The whole idea here was it didn't make sense for him to take up this offer because all the money literally was going to end up going to the government. And yes, there was a time when tax rates were that high. It was in the early to late 1940s to pay for World War II. But Bing turned down the offer because he would have almost nothing left after taxes. So everybody can understand that logic. Fortunately for Bing Crosby, there was a guy by the name of Basil F. Griot. And he's my hero. He's my hero. You'll see why in a minute. But he was Bing's hero too. And here you had Crosby's shrewd financial advisor, Basil Francis Griot, who then made a counteroffer to Minute Maid. And what he said to him is, look, don't give Crosby any money. Don't give him any money. Bing will set up a commercial production company, Bing Crosby Entertainment, that he will own as the proprietor. And this company will produce, with Crosby as the star spokesman, the Minute Maid commercials that you want. After the commercials are fully produced, and then of course he didn't say this, and Crosby has taken the expenses as a write-off against his personal income at 95%. So all the money he spent to produce the commercials, he could now deduct that from his income. So it only cost him 5 cents on the dollar for any costs he had to produce these commercials after tax. So after the commercials are fully produced, Crosby will incorporate the production company, which of course owns the commercials. Crosby will then trade all of the stock he owns in the production company for a small percentage of newly issued stock in Minute Maid. Crosby's lawyers set it up as a tax-free exchange. The tax law says if you're exchanging like for stock, then that's not a taxable event. So the lawyers were able to set it up for Crosby to exchange all of his stock in his production company for newly issued shares of Minute Maid. And this way, Minute Maid gets ownership of the commercials without having to pay out any cash. All they're going to do is just issue stock to Bing Crosby. Bing gets a substantial value in the stock, a few percent of a large company on which he pays no tax. Okay, so that's the nature of the transaction. Now let me do some graphics with you and some numbers with you that will help to make this whole thing very real and tangible for you. All right, let's look at the actual transaction. Okay, Crosby forms his production company with himself as the proprietor. So here he forms the company, Bing Crosby Production Company. Now he owns this company as a proprietor. So he's a sole person. There's no incorporation. He just owns the assets and operates the company as its proprietor. The company produces and owns the Minute Maid recorded commercials. Crosby deducts the expenses from his high tax income, reducing the amount of tax that he has to pay. So it costs him almost nothing after tax to produce the commercials. Crosby incorporates his production company. So now it's going to be a corporation instead of a sole proprietorship. But the production company still owns all of the commercials. And now Bing Crosby, instead of being the proprietor, he owns shares of stock in the Bing Crosby Production Company. Crosby exchanges all of the shares of the production corporation for newly issued shares of Minute Maid, and he does it on a tax-free exchange. So when the dust settles, Crosby owns shares of stock in Minute Maid, and Minute Maid owns Bing Crosby Productions with the commercials inside of it. Okay, so that should be hopefully very clear to everybody exactly what happened with this particular transaction. And Crosby owns his shares, remember now, tax-free. No tax. He's an owner of Minute Maid Company, doesn't pay any tax on any part of this transaction. To further illustrate this, let's look at some numbers. Let's put some numbers behind this. Let's start with before the transaction. And now these are made up numbers. They're designed to give you the concept of what happens, but by putting it in specific numbers, it should hopefully make the concept more clear. So before the transaction, meaning where Crosby exchanges his stock with Minute Maid, here's what's true. Shares of stock outstanding for Minute Maid are 1 million shares, and that's the total outstanding of the company. So whatever the total outstanding is, we're representing that here with 1 million shares. And it's all owned by the public. So the public owned the 1 million shares, and that represents 100% of the shares of the company. Okay, so that's before the exchange. All right, now let's look at the exchange, the transaction. Minute Maid issues 100,000 new shares to Crosby for the exchange. That increases the outstanding shares from 1 million to 1,100,000. So there's the public shares, then there's the new shares to Crosby, and then that's 1,000,001 total outstanding. And that's the tax-free exchange. Remember, Crosby pays nothing for shares. Crosby pays nothing in taxes. Okay, hopefully everybody's following me along with the numbers. Okay, now after the transaction, here's what's true. There are shares of stock outstanding now of 1,100,000. That's what equals 100% of the outstanding shares, as opposed to only 1 million here. 1,000,001 versus 1 million. The public owns 1 million of the shares, so they own now 90.9% of the total is owned by the public, and Crosby owns 100,000 shares, which is 9.1% of the company. So after the exchange is done, the public has been diluted down in percentage, not value, but in percentage, a little over 9%. And Crosby now owns that other 9%. And it happened through this process here. So there's 1,000,001 shares outstanding. 1 million are still owned by the public, but now Crosby owns 100,000 shares. And this is the percentage of that capitalization of the company. So hopefully everybody's got those numbers. All right, now the commercials that he produced, remember now they're owned by Minute Maid. So the commercials ran and they were phenomenally successful, but eventually they become dated. You can't run the same commercials with no change forever. So a new arrangement was made identical to the prior arrangement to produce a new set of commercials. So he forms a new production company, the same whole routine, and then he does a tax-free exchange of stock. All the same things happen all over again. Same thing. So this results in more tax-free stock for Crosby. And after a number of these transactions, Crosby became the largest single shareholder in Maid. All right. Now, again, we're going to go through some numbers here and share with you how this all happened. Now, I just went back to the numbers that we just covered because I didn't want you to forget what we just covered. So here's what we just covered. All right, now we're going to make some changes. We're going to make some additions. Okay, the earnings before the transaction, before Crosby made these commercials and they aired, the earnings before the commercials, we're going to say was $1 million, okay? So that's what the company earned. Then earnings after the commercials, because now those commercials brought in a lot of new buyers for the product. So now the earnings of the company were $1.2 million. And this is just some additional information around what we just went over. All right, so what Crosby did, now that he owns a lot of stock, is he got himself elected to the board of directors. He then convinced the other directors directors that with him as the spokesperson for Minute Maid, it would continue to be a very profitable company long into the future. Remember, Crosby's a superstar of his era, and that the best use of those profits, he argued, would be the repurchase of Minute Maid stock owned by the public. If you know this company's going to grow like a weed, the smartest thing anybody could do with any money would be to buy the stock. The company's going to buy it back. So it's going to be retired. That stock comes back into the company and it's no longer outstanding, and they pay cash for it. Where do they get the cash? Out of all the earnings that are going to be created by all these commercials that Bing Crosby's running. As the public stock was repurchased, it would increase the percentage of the company owned by the insiders. So any of the board members and Bing Crosby, who was a big insider, their percentages would now increase as the public shares were retired or bought back. So let's take a look at how that's going to work. And again, it makes their stock more valuable. So again, if you remember this illustration that's right over here on the left, this is what was over here on the right before. Remember, we had before, then the transaction, then after. So I got rid of all this stuff and I moved what was here after the transaction over to here. So that's where these numbers came from. So after that initial issuance of stock, this is what would have been true for the company. Okay. In this case, we're now going to look at the REIT and see what happens here. So 100,000 shares of public shares are repurchased by Minute Maid. That reduces the number of outstanding shares of stock back to 1 million. Because remember, it was up to 1,000,001, okay, when we issued Bing Crosby stock. But now Minute Maid is buying back 100,000 shares from the public. So it reduces the outstanding shares back to 1,000,000 shares again. Money for the repurchase comes from Minute Maid. Crosby pays nothing. So Crosby doesn't have to pay anything for the stock coming back, right? The company's buying it back. It's not coming out of his pocket. It's coming out of the company, all right? But watch what happens. After the repurchase, shares of stock outstanding were 1,000,000. Total 100% of the company was 1,000,000 shares. 900,000 was the public, and they owned 90%. 100,000 shares belonged to Crosby, which gave him 10% of the company. Now remember, before the repurchase, Crosby owned 100,000 shares, and that was only 9.1% of the company. But after the 100,000 shares are bought back and they're no longer outstanding, Crosby now owns 10%. So he went up 0.9% of the company. Okay, so that's what happened is he now owns more, but he doesn't pay anything more. He doesn't pay anything to anybody for that to happen. The company is just retiring its stock. Now, once you get this concept of what repurchase of shares does to the people who are the insiders in the company and aren't selling their shares, you start to see how the amount of shares that they own are not going up, but the percentage is going up because the public stock is being bought back. Method to my madness here, because when I start to share all the pieces with you, you're going to see what a phenomenal strategy unfolds here. With every repurchase of public stock, the price of each remaining share increases. Okay, why is that? I'll show you in a minute. Crosby's share value increases with each repurchase. All right, let me take what was on the screen before. I just took it and shifted it up. Same information, but I need to put some information underneath it. So we just shifted all that information up. Same information. All right. Now we're going to say that the company earns 1,100,000 for the year. And we're going to say the company earns $1 a share. Why? Because there's 1,100,000 shares outstanding. So if it earns $1,100,000, that means it's earning $1. The market price, what's called the PE ratio, the stocks in the public marketplace are based on a multiple of earnings. So we're going to assume a very modest PE ratio here of just 10 times earnings. In today's world, this would be an 18, 20 times earnings company, but we got to keep it simple. So market price is 10 times earnings. So that means that the price per share is $10. Okay, everybody got that? $1 a share earnings, 10 times multiple. So the price in the marketplace is $10 a share. Okay, and that's over here before the repurchase is done. All right, now after the repurchase is done, here's what happens. Okay, the company's earning $1.10 a share instead of $1 a share. Why? Because there's only 1,000,000 shares outstanding, not 1,100,000. So now the PE times 10 is going to stay the same, 10 times. The earnings per share is going to go up. The market price per share is going to go to $11 instead of $10 because the PE times 10 of $1.10 a share would be $11. So again, Bing Crosby hasn't laid out any money. This stuff is just happening because of the strategy that we're employing. The money's coming out of the company. But now the shares that he owns, the 100,000 shares, are each worth $11 a share, okay, or $1,100,000, whereas before the REIT happened, he owned 100,000 shares that were worth $10 a share. So he still owns the same 100,000 shares, but the value of those shares because of the REIT went from $10 per share to $1 per share. So hopefully everybody's clear on what happens. This is the nature of the public marketplace, and this is one of many reasons why companies go public. So again, if you look at the market cap of the company, it's $10 million before the repurchase. Crosby shares worth $1 million. And after the repurchase, the market cap of the company is still $10 million, but Crosby's share is $1,100,000. Now, once you got the technical realities of these two things, Crosby is going to do new transactions because he's going to continue making new commercials for the company, getting more shares. Then the company is going to use the profits that they generated from the commercials, and they're going to use it to buy back the public shares, making the shares of those insiders worth more money, of which Bing Crosby is one. So those are the two functions that are going to be happening, and now let's look at it when we take them together, and we'll see how Bing Crosby took control of Minute Maid. All right, to restate, Crosby kept producing commercials and trading them for more stock tax-free. The number of shares he owned went up as the profits were used to reduce the total shares outstanding, buying them back from the public. Each year, Crosby owned a bigger and bigger percentage of Minute Maid until by the time he died, he and his family owned over 60% of the company and exercise complete control. Now, this is just one example of how an entertainer, sports celebrity, or social media influencer can use their talent to take control of a majority ownership of all size companies. It doesn't have to be public. The concept works no matter who the owners are. You can still use this strategy to accomplish exactly what you saw here. More efficient with a public company, but it can even be done with a private company as well. Now, celebrities and others with substantial followings on social media can own a business or a substantial interest in a public company and do it without paying big taxes. And you can make it work for them with you as their partner. I will guarantee you there isn't an influencer, there isn't a celebrity, there isn't anybody who has these big followings that has a clue about what I just shared with you. And you are right now in a position to bring knowledge to them that can make them extraordinarily powerful and extraordinarily wealthy. And without you bringing it to them, they will not know it and they won't be able to do it. That being said, knowledge is power. And right now, it's knowledge that you have, and bizarre financing, knowledge is power. And you have the advantage. They only have their following. That's all they got. That's a lot. It's worth a lot. That's all they got. On the other hand, you can have dozens of partners. You don't have to just do this with one celebrity or one influencer. You can aggregate them. You can bring groups of them together. You can do one and another one. For you, the world is endless with this. And you can make it work for them with you as their partner. So whatever they're going to build, you're going to do what Basil did, which is to be biggest partner and make a fortune along with your influencers and your endorsers. Knowledge is power. Now, think about this. If anyone around Jordan knew what you now know, Jordan would own control of Nike. What companies could LeBron James own and control if he knew what you now know? All right? Knowledge is power. I have to keep on saying it. Now, I'm going to get into this in more detail in a moment, but before I go into it in even more detail, I want to make sure that everybody's clear on what this is all about and that any questions of what we've covered so far can be answered. Again, the proverbial question, do you have any questions? Any questions? I'm hoping I just did such a great job of explaining that you don't have any questions, because you don't. I'm going to have another question opportunity for you in a few more minutes. The fact that there isn't any questions right now, no problem, because you'll get a second shot at this. All right, so let's move on. I want to tell you something from my heart. We've been here now for 29 minutes. If this isn't the most valuable 29 minutes in your life, I don't know what to tell you, because this strategy in today's world where endorsers and influencers are so powerful and they have no clue how to fully execute that power in ways that will create real wealth for themselves, you are in a position to make money like crazy. Okay, and I need you to see that. And I know what you're saying to yourself, I don't know any of these guys. That's why we're moving on here. I know this looks like a lot to observe, okay, but we've already seen this, okay? We've already seen it. The only difference is we've expanded the numbers. We had $1 million here, we had $1 a share here. For some reason, when these charts were made up, one chart was made up at 10 times the size of the other. Everything's the same. It's just these numbers here are 10 times bigger. But remember, we're talking concept here. So just roll with the concept. Now we're talking about a $10 million company at $10 a share, still 10 times earnings. The shares are now worth $100 instead of $10. So all these numbers are just the same as we've already seen. They're just rolled out for a slightly bigger company. So the charts were produced at different times with the help of different folks. So bear with me. We just made the numbers bigger, but they're still the same concept. All right, we're going to get rid of all that stuff that was over here. And now we're going to look at just what happened at the end of that last transaction, where we are now going to do another one of these transactions. So in effect, we're going from here to where there's 1 million shares outstanding to now we're going to do a second round where we're going to be buying back shares from the public again. Okay, so you can see what happens. Shares of stock, 900,000 total, 100% company, 800,000 public, 100,000 Crosby. What we're trying to show here is even if he never did this again with a new production company, new exchange of stock for commercials, that what would happen is if he just kept buying back the stock and only did that original transaction, what would happen? Because I want you to see him in isolation. One was we showed what happened if he does several of these, and now we're showing what happens if he just does several repurchases without getting more stock. Now, instead of 1 million shares, there'll be 900,000 outstanding, of which now 800,000 would be owned by the public, 100,000 would be owned by Crosby, and the company's earning $1 a share, market price 10 times earnings, market price $111 a share, market cap 10 million. Crosby shares are worth 1,111,000. All right, so that's all we're saying now is what all that happened was he just now did a second round of repurchases using the profits of the company to buy back the public stock. Now, here's what's interesting. One of the comments that people would make is he's getting all his stock, and you can't eat stock. He can't build an Italian villa out of stock. He can't buy a Maserati with stock. Okay, he eventually has to come back into cash in order to improve his lifestyle, in order to have more money to spend, in order to invest money in other things, whatever he's going to do. It's got to come back to him in cash. So now the question is, how do we get it back to him in cash? Here's the good news. Once you got this stock, especially if it's in a public company, Crosby can borrow against his stock. So if you had $11 million worth of stock, you can take that to the bank, collateralize it, and borrow up to 60% against that stock. So that's $6,666,600 that theoretically he could borrow against the stock that he owns. And when he gets a loan, this is not income to him, right? He can get the cash, but it's a loan. That means he doesn't pay tax on this. If you then take 2.5% interest, which is what it was back in his day, it's a little more maybe now for a loan like this, it might be 3%, 3.5%. Remember, interest rates are still low right now, all right? So it would have cost him to borrow against this 2.5%, or in this case, to borrow $6.6 million, would have cost him $166,000 in interest. But remember, the interest is tax deductible, okay? So he can deduct this interest. So if you then apply his 95% tax bracket, in after-tax cost to borrow this $6 million only cost him $8,333 in after-tax cost, all right? Now, if you look at it this way, the money that he pulls out by borrowing it is several times what Minute Maid would have paid Crosby to do the commercial. So he's got now more money in his pocket than if Minute Maid gave him the cash for producing the commercials. In addition, he has over 100 times what Crosby would have had left after taxes if they paid him the money, because the government would have taken 95. This is astounding that this could be accomplished. All right, now $1 million cash to Crosby, this concept, $1 million cash to Crosby only yields him 5% after tax. So if you pay the man $1 million, he was only going to have 50,000 left, and he ends up with 133 times more, i.e., this, than if he got paid $1 million up front in cash. Okay, so the ability of these financial structures is awesome, and nobody knows about these things. And if they do, they're clueless of how to execute them. And there's all these people making all this money out there, paying loads of money in taxes. And guess what's happening to taxes in the next year or two, folks? I mean, you're talking major tax increases. Everybody out there is going to be wanting to know, how do I cut my tax bill? I mean, if you're an influencer or a superstar or a celebrity, you got major challenges keeping your money right now. And it will be more so every year that goes on for the next 2 years, maybe even 3 years, until somebody hopefully turns this whole tax nonsense around. But that's what's coming. Crosby invested the loan proceeds in growth investments with no tax until he sold. What did he do? He put the money into real estate. So he took all this money that he borrowed here and he put it into real estate, which now grows tax-free. And then the depreciation on the buildings gives him more write-offs. Do you think he had good tax advice? Do you think Basil was a genius in how he structured all of this to give this kind of a return on his talent to Bing Crosby? This is awesome. By then, the tax rates had come down and he paid even lower capital gains tax. So now, during this years of the government with all that 95% tax to repay for World War II, eventually those tax rates came down. So when he came out of these properties, yes, he had to pay capital gains tax on all the value of what he sold off at that time. But guess what? Basil had them doing exchanges. They exchanged this property for that property, no tax, okay? So anytime he did convert it into a sale, yes, there was capital gains tax, but now that capital gains tax was way lower than income tax, and both capital gains and ordinary income tax were much lower that 5, 7, 10 years later when he started coming out of those real estate properties that he had bought with these transactions. Knowledge is power. It's also wealth creation. Now, I know what you're saying to me, at least you're saying it in your head, is, well, you don't know any superstars. You don't know any super influencers, and you don't know any way to get to them or their business managers. So here you now have all this wealth creating knowledge and you don't have anybody to do it with. We got to fix that, right? Be creative, okay? That's always the answer. Be creative. There is a plethora of lesser knowns who would love to own their own small or mid-sized business. Help them, aggregate them, And the lesser knowns are not that hard to get to. And you start working with a couple of not so successful people, but who are successful enough that either one, two, or three of them can work this with you. And you'll meet their business managers. The business managers who have high income people also have some up and comers who aren't that level yet. So if you dip your toe into the water, if you get started with the folks who are accessible or who you can reach out to or you can network to, that will lead you to the bigger fish. And every time you introduce this to a business manager for his little guy, the first thing they're going to say is, can we do this for so-and-so too? Because I manage him as well. And the next thing you know, you're doing it for really big folks. And it doesn't matter that you start a little small with this, get your teeth wet with it, your toe wet or whatever you get wet. And next thing, you're making it happen. All right, another shot at questions. And then I got another bonus thing to share with you. Going to knock your socks off. All right, but let's get questions. Oh, I got a question. Let's see what you got, Shawnee. All right, and then I got one from Jay as well. So let's take Shawnee. How would Maid pay for the commercials using stock? What about today? How common is it for companies to pay for something using their stock? Companies pay for stuff using their stock all the time. It's just that normally nobody wants to take their stock because everybody in the world we live in would rather have cash because they don't understand the nature of public stock. So they're happy to just get cash. And unless somebody had this kind of grand design to follow, think about it, they're better off with cash. And especially at today's tax rates. Today's tax rates aren't so imposing as they were back then. So given that the investment community and the CPA community aren't very aggressive, they all want to do the stuff that everybody else does, people just want to use cash. It's simpler. I don't opt for simple. I opt for what pays everybody big time. And if you're a company and you want a Michael Jordan or a LeBron James or some big, really great celebrity to give you an endorsement, if they say, no, don't pay me in cash, pay me in stock, believe me, the company's going to pay you in stock. Because I guarantee you that these folks, when they do endorsements, they get mostly cash, but I'll guarantee you that the company throws in some stock too. But there it's a kicker, a benefit. It's not built into the core of how to create some serious wealth. And remember, the big corporation, they're not thinking of their endorser taking control and end up owning the company. So they're completely blindsided to this. There's nobody around who understands this anymore. It's just not out there. It's not used, but it's there. And its potential is awesome. In any event, why would Minute Maid pay for commercials using stock? They would pay for the commercials using stock because it's an efficient way for them to get them. Companies deal in their own stock all the time. They buy shares and retire them. They sell more shares into the marketplace with secondary offerings. There are many companies that right now are wanting to conserve cash because there's a lot of unknown roadblocks ahead, and they would just as soon use stock to solve a challenge or a problem. And the way you find out is you're going to be talking to CFOs of these companies, and you're going to be discussing with them the idea of doing a stock-free exchange as a best way to get a endorser who can do major income generation for their company. All right, next question was by Jay. It says, I understand celebrities did use that technique. How can we use that technique? You can. Okay, you can, because what you're going to do is you're going to take a company that you're building and eventually you're going to take it public. You're going to IPO the thing. And when you do that, you're going to want to acquire things for stock. And you're going to be able to show people how you're going to create a fortune for them when you buy things for stock from them instead of paying them with cash. You're going to be able to show them by a similar illustration. I can't go through that now, but I'll maybe make that the topic of another one, which is what if you don't have a big endorser, but you're a growing company and you want to buy other companies, or you want to buy other product lines, or you want to buy endorsers, or you want to buy anything and you want to use stock to do it. What argument do you have to get them to use your stock instead of cash for the transaction? They're every bit as strong as everything you've seen here so far. And we'd be happy to get into that. But if you've got a public corporation, you have a printing press for money, because you just go down into the basement, you print up more shares, and based on the selling price of your stock, you're going to have buying power with those shares. And then the only thing you have to be careful of as the company is that every time you issue shares, you buy enough earnings per share that you give out that your earnings per share keep going up because the number of shares you issue are less than the amount of earnings that they bring in, meaning you got a 10 times earnings multiple on your stock and you're buying something that produces $1 million worth of earnings. So that's going to increase your cap value or your company's value by $1 million times 10, or $10 million. You bought $1 million worth of earnings. So you've got to be careful that you don't give out more than the number of shares at $10 that equal the amount of added capital to your company. So you're always buying stuff at a less of a PE ratio than the PE ratio of your public company. And as long as you're doing that, and especially if you have enough margin between those two, you're always increasing the price of your stock every time you make an acquisition with stock. That's the key. You got to buy enough earnings with the shares you're issuing, that at your PE ratio, you're coming out with a higher earnings per share than you would have had you not made that purchase. All right. So again, I'm oversimplifying it to some extent, because if I don't, then you don't get the basics, but I think that should cover it. Okay, let me get on to the last segment of this while we still have time. We're going to look at this in a little different way than we did before, to try and again zero in on exactly what's happening in these transactions. My question to you is, how can you use what you learned here today to get rich? That's what I want you thinking about after this webinar is over. How can you use what you learned here today to get rich, to become a hectomillionaire? That's $100 million. To become a billionaire. Because if you wrap this strategy around the right approach and execute it with the right people, the amount of money that you will create for yourself is almost unlimited. And you can have as many partners as you can get out there and call on and interest in this. And the first one you do is going to lead to the next one, to the next one, to the next one. So you start small and you work your way up if you don't know these folks. All right. The last thing I'm going to cover with you today is to show you what the whole sequence looks like when it's put together. And we're going to start with that very first transaction before the commercials were made. And this is what was true for the parent company, for Minute Maid. And we're going to just look at it again, step by step. We're going to say they had 1 million shares outstanding, which represented 100% of the company, okay? And that their earnings were also $1 million. That they had a 10 times PE ratio, which 10 times a million is a $10 million market cap. This is what the company is worth, 10 times its earnings. And since it has 1 million shares outstanding, its price of its shares are $10 per share. Then along comes the deal with Crosby. They issue 100,000 shares, but when they do that, they then run these commercials and produce another 300,000 in profit, 300,000 in additional earnings. So they increased their earnings by 30% because of the deal that they made with this incredible talent and super celebrity, Bing Crosby. By the way, the results for Michael Jordan were even better than this. Nike wouldn't be Nike without Michael Jordan. And Minute Maid wouldn't have been Minute Maid without Bing Crosby. It was the same type of thing. All right, so now after the commercials run, okay, remember, this is what they did. They got the 300,000 of earnings by issuing the 100,000 shares. So after the commercials are running, here's what's true. Now the company's got 1,100,000 shares outstanding, 1 million owned by the public, 100,000 owned by Bing Crosby. You saw these numbers before, these ratios. The company is now earning 1,300,000 at a 10 times PE ratio. So the market cap on the company is worth $13 million. That's now based on 1,100 shares. That's $11.82 per share. The market cap for the public of what they own of the 13 million is 1,118,000. And Bing owns 100,000 shares at that price, or $1,181,818. Okay, so that's where that got to. But now they're going to do this kind of thing again, but the public shares that they redeem, because that's the next step, right? They're going to redeem public shares now, where they're going to take this 1,300,000 of earnings that they got, they're going to take and use it to retire 100,000 shares of the stock. So they pay cash for the stock, they buy back 100,000 shares, and then here's what's true. The company's back to 1 million shares total outstanding because they bought back 100,000 shares. The public only owns 900,000. Crosby owns 100,000. So now instead of these percentages, it's now here. And so 90% owned by the public, 10% owned by Crosby. The market cap is 13 million because the company's making $1,300,000. That's $13 a share. And so the part owned by the public is 11,700,000 of the market cap, and Crosby's share is 1,000,003. So you can see what happened here is Crosby's share just from the repurchase went from $1,181,000 in value to $1,300,000 in value, but he still owns the same number of shares. All right. Hopefully everybody could see that. Okay. Now we're going to do a second round of all of this. And in case you had any problems seeing that, I'm going to do a little trick here, which is to take and zoom in on this so that you can see it maybe a little bit easier. All right. So now we start out in the same place we ended up before. Okay. This is what the last column, the last leg of that other journey looked like. But now Crosby is going to get a new 100,000 shares. And this time, when it increases it by 30%, that's going to increase the earnings by 390,000. So after these shares are issued to Crosby and the commercials run, there's again 1,100,000 shares outstanding. The public owns 900,000 shares because remember, we bought 100,000 back from them before. But now, because 100,000 new shares were issued, their 900,000 shares only represents 81.8% of the company. Bing's 200,000 shares represent 0.2% of the company. The earnings are 1,690,000 when we add the earnings here. Same ratio, multiple for earnings for pricing the stock. But now the market cap of the company is 16,900,000. That's $15.36 a share, of which the public's value went up to $13,087,000, but Crosby's shares went up to $3,072,000 because he now owns 200,000 shares. So now we're going to do a redemption again because we're going to take his $1.6 million of earnings here that we had in the company, and the company is making more money than it needs, so we don't need to keep the cash in the company, so we use it to buy back more stock. Okay, so $1.5 million is used to buy back the 100,000 shares, and after that it looks like this: 1 million shares outstanding, 800,000 public, 200,000 Crosby. Crosby now owns 20% of the company. The earnings are the $1,690,000, 10 times earnings. Market cap of the company, $16,900,000. But now the price is $16.90 a share. Public's value went down, but that's because they went down 100,000 shares. But per share, it went up. Everybody's making more money with this transaction. Everybody. There's $13,520,000 value in the public for their 800,000 shares. Crosby's 200,000 shares are now worth $3,380,000. Hopefully everybody got that. You can see what happened after just 2 cycles. Let's have a third cycle. Now, you should hopefully know these figures well enough that I can stay with them all on the screen. You don't have to see each one like we did here. I wanted to blow it up so you could see it. But look at what happens now. Okay, you go through all the same things again. Everything that we just did with the company issuing more shares to Crosby, with the company's buying back the 100,000 shares. So at the end of the third cycle, you now have 1 million shares outstanding total. The public only owns 700,000 shares, but Crosby now owns 300,000 shares, or 30% of the companies. But the earnings, because of the earnings increase, is now worth $2,197,000 of earnings. At the 10 times multiple, the market cap is $21,970. $21.97 a share. Public owns $15,379,000 worth of the stock, and Bing Crosby now owns $6,591,000 worth of the stock. But what I want you to see is in this scenario, everybody's winning. Everybody. Okay, the public's winning. Why? Because their shares went from 1182 to 13 to 1536 to 1690 to 1997 to 2197. Shares have doubled since we started this process in the first cycle for the public. The people who sold, they got their price at the time that they sold. But everybody who's a stockholder is winning. Everybody. But who's winning really big here? Crosby. Okay, now let's take the fourth cycle. Okay, go right to the bottom line here. You already know the process. So you got 1 million shares outstanding. The earnings are $2,856,000. 10 times earnings, a $28.5 million company. And so you have 17 million of cap value owned by the public and 11 million of cap value owned by Crosby at $28.56 a share. All right, so now we took what was over here and we moved it over to the left. So this was what was over here. This was the third and fourth cycle. So now we're going to go to the fifth cycle, and then we're going to end with the sixth cycle. So in case you're wondering where does this end, that's where it ends. All right, and again, you look at it, the company's now got $3,712,000 in earnings. It's a $37 million cap company. It's got $37.30 a share. So everybody's winning. The public still owns 500,000 shares. That's worth 18 million. Crosby's 500,000 shares are now worth 18.5 million. And then finally, the last leg of the journey here was in the sixth cycle, where what's happened here is, and maybe here I'll do the blow up so you can maybe see it while I'm giving it to you. All right. But what happens here is the earnings are $4,826,000. That's a $48 million market cap. Shares are $48.27 at the public price. The public only owns 400,000 shares now, and that's worth 19 million. And Bing owns 600,000 shares, which is 60% of the company. So he has absolute control now, but his shares are worth $28,960,000. So that's the scenario, folks. That's how it all plays out. All right. So I want to thank you all for your enthusiastic presence here today. I hope you learned enough to set yourself on a course of how to become a hecto-millionaire or a billionaire, because you have the know-how, the knowledge, and anything else you need to know. You just got to get out there and roll up your sleeves and just do it. And yeah, you'll learn a few lessons. You can also call me. I'll help fill in the blanks for you. But the point that I'm getting at is this has been a phenomenal exercise and hopefully stimulated your imagination, your creativity, get yourself thinking about how you can employ this thing for yourself, taking talent that's already out there, already making its incomes. Now, how do we help them convert those incomes that they can generate not only for themselves, but the incomes that they're generating for the companies they're promoting and endorsing, and turn that into mega wealth for themselves? Mega wealth. That's what we're talking here. And I know it sounds a little complicated, but the reason I gave you the handout that I did is so that you can live with this thing, go through it over and over again. We will have this video posted on the library. Listen to it over and over again until finally something clicks and you see exactly how you can put this to work for you. All right. Again, thanks for your participation here. We have another one of these coming up in 2 weeks as an essentials webinar, and then another one, of course, on the second Wednesday of next month. So until the next time we're together, I'm wishing you all the best of success. And get this one, folks. This one can make you a lot of money.